When you finally start paying yourself in your business, the big question is, how do you actually pay yourself? Do you just swipe the business card when you need groceries, or do you just set up a form of paycheck? The answer depends on whether you're using a draw or a salary, and that choice shapes your taxes, cash flow, and even your business future. In this video, we'll spell out clearly what exactly you need to do and which option will be best for your situation. And by the end of this video, you won't just get paid, you'll get paid the right way. Most business owners think grabbing money from their business account for personal bills is harmless, but this simple habit can shut down your financial stability later. It feels easy in a moment when you see cash in the account and you use it to pay your car note, swipe for a quick grocery run, and you promise that you even it out later. But what starts as a convenient often creates a trail of confusion that's often hard to clean up later, especially when tax season roll around the corner and you're trying to figure out where your money went. In the early stage of a business, it's natural to get excited when revenue starts coming in. You finally see your product selling or your business service being booked, and for the first time, your bank account looks a little healthy. That's a great feeling to have, but it also draws the lines between personal and business, and it can get a little fuzzy. You might not think twice about pumping gas with the company card or running a quick Target pickup order through the business bank account, since after all, it's your business. The problem is, what feels harmless may actually overlap and changes the way your finance gets recorded, and 9 times out of 10, it's not in your favor. Let's take the case of a business owner who ignored that separation. He uses his company debit card to cover groceries, Netflix subscription, and even a family vacation. At first, those charges blend right into a sea of legitimate expenses, but when tax time come around, nothing was simple anymore. His accountant couldn't tell what was deductible purchase or what was just a fun weekend. That mixed up not only cost him a valuable deduction, he ended up with a larger tax bill and hours of frustration trying to explain each receipts. It doesn't just stop there. When you commingle fund, you don't just create an accounting headache, you actually put your business protection at risk. If your company is a limited liability entity, mixing the money can weaken the shield. In the eyes of the law, if you treat the account like one giant piggy bank, then creditors might do the same. That means your personal asset like your car, your savings, could be in jeopardy if something were to ever go wrong and God forbid somebody tries to sue you. And then there's the IRS. They're not just looking for fraud, they're looking for sloppiness. If your records are incomplete, you may miss write-off that you're entitled to, or worse, if they can't do a paper trail, they can consider that your taxes are unsustainable. And that's how a business owner ends up paying double taxes or deduction because they can't prove that was personal or business. Even something as small as a $50 online shopping on the wrong card. That entity cannot defend themselves if the question would ever arise. Separating money isn't only about following the rules, it's about giving yourself peace of mind. When your business account shows its true balance, you can make real decisions from real numbers. You know exactly how much is available for reinvestment, payroll, or taxes without even guessing. That kind of clarity helps you sleep better at night because you're not worried about accidentally overspending or mismanaging your company's cash. Now let's say your business account are separated from personal. How do you actually pay yourself without draining the business dry? It's not as simple as moving money back and forth when you feel like it. It's also doesn't have to mean locking yourself into a strict paycheck. This is where owner's draw comes in. They give you flexibility, but using them in the wrong way can cause real issues later. An owner's draw is basically pulling money out of your business account for personal use. Instead of running a payroll like an employee, you can just take funds when you need it. That makes sense for small business owners because cash isn't often consistent. Some months you bring in a surge of revenue, and some other months you bring in a low amount. And with the owner's draw, you ain't stuck paying yourself a fixed salary when cash isn't there. You can adjust, which feels, pretty much freeing you from a structured, regular, bi-weekly paycheck. They start transferring funds for vacation, impulse purchases, or even just daily living costs without thinking about the larger picture. The problem isn't about taking the money. It's about not having a plan for it. A draw that isn't carefully tracked can throw off your cash flow, or worse, if you don't realize it, you might have a large tax bill later that you don't have money for, so you have to plan accordingly. Mechanically, the draw process is simple. You transfer money from your business account to your personal account. The key difference is the record keeping. Every transfer should be noted as a clear description, date, amount, and purpose. You might even write a check from your business to yourself, or you might initiate an electronic transfer. Either way, what matters is that your book shows it as a draw and not as an expense. That distinction protects you when your account prepares your personal taxes and your business tax. Let's take, for example, this lady who had a great first year in business. She was excited. She pulled frequent owner's draw for the business for shopping and meals, and when her quality tax deadline came around, she realized that she didn't have enough money in her checking account to cover the payment. All that money was spent personally. She hadn't done anything illegal, but she had failed to plan properly. She could have handled that a little bit differently by planning properly, but she didn't, which caused a financial scramble and months of stress. What could have handled differently became a financial scramble and caused months of stress. If she had planned properly, she would have avoided all of that. This is where the understanding of pass-through taxation becomes important. If your business is a sole proprietor, a partnership, or an LLC, profits are passed through to your personal tax return. That means the IRS tax you on the total profit, whether you withdraw the money or not to your personal account. It surprises a lot of people. You don't avoid taxes by leaving the money in your business account. That balance still shows as a profit. That means you're still gonna get taxed tax on it. On top of that, there's self-employment taxes. Right now, the rate of a self-employment tax is 15.2%. It's pretty high, but it covers Social Security and Medicare. It applies to your entire profit, not just your take-home amount. If you set aside funds for it, then your tax bill will not feel overwhelming, but if you don't, it's going to feel overwhelming. A good habit is to reserve a portion of each paycheck that you take or ownership that you take to pay yourself into a separate savings account that meant only for taxes. That way, when the deadline arrives, you aren't scrambling to pay them. Just make sure you're mindful when you're taking an owner's draw. It's good to enjoy the fruit of your labor in your business, but you have to be mindful that the business needs some form of expenses for the next month. So leave enough in the account to cover some operating costs, some reinvestment, and taxes. So you actually are protecting yourself down the road. It all comes down to being disciplined, and you also have to document everything. Recording every draw as an equity distribution keeps your books accurate and avoid confusion during tax prep. And it shows the IRS that you're not misleading or hiding expenses, keeping your finances in order and giving yourself control over the future. Paying yourself isn't about how much you can grab. It's about setting up a system that keeps both your business and your personal life steady. When money flows correctly, you avoid stress and you also protect your asset, and you can actually see where your profits are going. Don't forget to like and subscribe and click the link below for a free consultation, and me and my team could definitely get you going if you need bookkeeping for your business.